Indicators are little tools and graphs and stuff that can help give you buy or sell signals. Buy and sell signals are little flashy signals that tell you buy here, sell here, and they're used in conjunction with each other to validify each other. If you have a handful of buy signals are all saying the same thing, then that means it's a stronger buy signal versus having a bunch of indicators that some are saying buy and some are saying sell. They're used in conjunction together to determine whether or not you should buy or sell. And when they're all speaking the same language, it's a stronger signal. Two of the most popular indicators used are the RSI and the MACD. The RSI, I'm not really even sure how it's calculated. All right, I've looked it up a few times, but I keep forgetting. It's not important to know how it's calculated. It's important to know how it's used. The RSI, and I'm going to make it a little bit bigger here, correlates with the stock chart. As the stock chart goes up, so does the RSI. As the stock chart goes down, so does the RSI. When it goes above these levels to the upside above this yellow line, that means that it's overbought. When it goes below this yellow line, it's oversold. And it turns red for a sell signal and blue for a buy signal. And you can see it's relatively accurate, right? If we follow where this red sell signal is, or straight up, well, the stock price starts heading down. If we look at this blue buy signal, the stock price starts heading up. Here again, it becomes oversold down here, oversold blue, and it starts heading up again. But you also get these sell signals that are just so miniature that they're not important. For example, this one says it's overbought, meaning that's a sell signal. It drops a little bit, but it's really easy to hold for too long and end up losing money. And then it stays overbought for quite a long time. So that's why you don't solely rely on the RSIs, because sometimes it gives you false signals, but it's something to look at to validify your previous analysis. In addition to this, to just using it as an overbought a sell or an oversold a buy signal, there's also something called divergence with the RSI, where the RSI indicator is diverging from the stock price. In this case, you can see that there's a high right here, which correlates with a high up here. And the next high, which correlates with this high, is lower. It's lower on the RSI, but yet it's higher on the stock price. This is a bearish signal, and this signal, in my opinion, is what the RSI is most useful for. When you see, in this case, what's called bearish divergence on the RSI, this is a pretty strong signal that you might see a downtrend. I personally, just from my use of it, have found it to be really, really, really accurate. At least much more accurate than just using an overbought or oversold signal on the RSI. Another example right here is bullish divergence, where you have a low here and then a lower low on the stock price, and then you have a low that correlates with that one, and a higher low on the RSI. So the lows are going in opposite directions. This is bullish divergence, is a buy signal, and you can see it's a damn good buy signal. Is it always correct? No, it's not, but it has a high correlation with being right. And the more the divergence is, the higher chance that it's going to work in your favor. Now, this kind of sounds like astrology for men, and technical analysis has been criticized for being so, and I've been open-minded to the idea that maybe this is all just BS for the most part, at least when it comes to indicators, and some indicators totally are just gobbledygook. But in my opinion, just for my personal use of the RSI, it works well. It's a helpful clue. At least you can look at it and say, yeah, the correlation between oversold and overbought as sell and buy signals has to be somewhat correct because it's correlated with the stock price. If the stock price goes up for an extended amount of time, odds are it's going to have a correction. That's just how the stock market works. People start taking profits. People are scared that other people are going to start taking profits, or the stock price is just overextended and people just assume that it's above intrinsic value. So if the RSI is correlated with the stock price, that means that if it's been going up over a long period of time, the RSI shows an oversold signal, overbought signal, there's a higher than 50% chance that the RSI is going to be correct. So in that way, the RSI can be kind of bullshit. You know, it's basically just following where the stock's going. And if it shows a sell signal every time the stock price goes up for a while, well, I could tell you that without even looking at the RSI. So it's slightly useful in giving you a hint on, like, is it a little bit overextended in either direction? But do not bet the farm on it. Okay, those are just my thoughts on RSI. MACD. MACD stands for Moving Average Convergence Divergence. And to explain the MACD, I first have to explain what a moving average is. A moving average is a series of points, which is simply a line, where each point takes the average closing price over the last however many periods. So if we're looking at a daily chart and we have a 30-day moving average, a 30 moving average, that 30 is called the length of the moving average. That means that it takes a point today, puts it on the stock price, on the stock chart, that is the average price of the last 30 days closing prices. So it adds up all the closing prices of the last 30 days, divides it by 30, so it takes the average, puts it on a point, throws it on the graph. These moving averages show the overall trend of a certain period. If you're looking at a 30-day moving average, it's showing kind of the more recent trend. When a longer-term moving average, something like the 100 moving average, and a shorter-term moving average, something like the 50-day moving average, cross, it gives you either a buy or sell signal. So for example, if we look at the stock chart here, this kind of bluish line here is a 200 moving average. So we're looking at the daily chart. It takes the last 200 days and puts it on a point as the average closing price of those last 200 days. This pink line here, this is the 50 moving average. So it's a 50-day moving average. If we come over here, right where these intersect, this is giving us a little bit of information. Granted, it's a false signal, but it's giving us a little bit of information nonetheless. This 50-day moving average, which follows the price of the stock a little bit more closely, crosses below the 200-day moving average, which is saying that the shorter-term trend is in direct conflict with the more longer-term trend, which is a sell signal. If in the short term things are starting to shift against the longer-term trend, that is a sell signal. The exact opposite is true when it starts crossing above it, which is a buy signal when the shorter-term trend crosses above a longer-term trend, longer-term moving average. So that's one ways moving averages are used. In this case, this is called a death cross, and this one's called a golden cross, if I remember correctly. So when it's a bearish signal, it's a death cross. Bullish signal, it's a golden cross. And moving averages are also used to identify the continuation of a trend as a level of support or resistance. So in the same way those price levels act as support and resistance, when a stock price moves back to a moving average and bounces off of it, that is saying that that trend is still holding. That line, that moving average, is acting as a level of support. Typically, the most common one used in this manner is a 200-day moving average, because if it stays above the 200-day moving average, it means the current trend is continuing. If it goes below it, then it means there might be a change in trend. The stock price is in direct conflict with the overall previous trend. Anyway, so that's what the MACD is, the moving average convergence divergence. It takes two moving averages. One is an exponential moving average that puts more weight on previous closing prices against another moving average, and every time it crosses, the shorter term exponential moving average crosses below the longer term average, it's a bearish signal, and every time it crosses above, it's a bullish signal. So in this case, that's a bearish signal right here, and over here, this would be a bullish signal. And you can see how it correlates to the stock chart, where the bearish signal is pretty dang accurate and the bullish signal as well is pretty dang accurate. So MACD is another clue telling you where it might be a good time to buy, where it might be a good time to sell. And you want to combine it with the RSI as well as the price action that we discussed earlier to gather up your thesis and determine whether or not it's the right time to buy or sell. So those are the two I use. There are a million indicators out there. I don't understand the majority of them, and I don't care to understand the majority of them, particularly because I don't like swing trading. I don't like day trading because longer-term trends are more easily identifiable. So you start looking at from primary trend to primary long trend to secondary trends, which are the dips, to tertiary trends, which are the intraday trends that are in their little minute trends that day traders take advantage of. The more zoomed in you get from secondary to tertiary trends, the harder it is to identify the trend early and the shorter the trend's going to be, so it's hard to hold on long enough to make money. So that means that people always see trends where maybe they aren't and highly leverage themselves into them, and then they end up being wrong and they lose money. That's why 99% of day traders fail, is because day trading is basically gambling. And a lot of emotions are involved. So for those reasons, that's exactly why I use technical analysis for price improvement and not as a means of directly making money. I've made money using it and I've lost money using it, and I just prefer not to. It's too stressful. I'd rather use it for price improvements and stick to my favorite things, which are leaps, long-term investing, and the wheel strategy. None of those things freak me out at all. I understand them perfectly. And even when I'm losing a bunch of money on leaps, I have so much faith in my understanding of leaps in the markets that I can sleep like a baby at night. You do you, babe. You can use technical analysis to make money if you want. You have to have very stable emotions. That's the biggest part about it. And you have to stay rational and see the bigger picture at all time and not get lost in the little tiny price movements. Or you can be like me and use it for a price improvement. You know, if you're going to buy leaps or whatever, you're going to take a look at the intraday time frame, see if things like a trend is shifting downwards, or if there is a downtrend, then maybe you wait or set your limit price lower. And always keep an eye on volume to justify any sort of price action that you're looking at. The last thing we're going to talk about are stock chart patterns. Stock chart patterns are patterns on the stock chart. They literally are patterns. They look a certain shape. Okay, might be a smiley face, might be a couple bumps or whatever. A common one is a head and shoulders that looks like this. You have a stock price go up, down, really up, really down, up and round, and down again. This is a bearish signal. It looks like a head and shoulders right, and when it breaks that neckline right there, that is a bearish sell signal right in there, especially when there's high volume. That's a stock chart pattern that repeats across time. The idea is that people in similar situations or in similar emotional events are experiencing similar emotions behave a similar way across time. And when they buy and sell in predictable ways in similar ways across times and similar events, then you'll see that represented in a stock chart as a similar pattern that repeats itself across time in similar events. And while the shape may look a little different here or there, it's not going to look the exact same, it can still be identifiable and you can still capitalize on this herding behavior and this repetition of behavior in similar events. I'm not going to go through a bunch of stock chart patterns. I'm just going to put a link to them in the description below and you can study them if you want. While they are useful, and, they can help you identify trend, it also falls prey to the same problem that basically all of technical analysis falls prey to, and that is people trying to find stuff where stuff just isn't. Or the stock price moves in a way that looks like a head and shoulders, but it's just random price movements, because random price movements are in there. Not everything means everything. So people are hallucinating stock chart patterns all the time, or it shows a stock chart pattern, but it's actually not valid. It's just random price movements, and people make their buy or sell decisions based off of them and lose money. So they're useful, but here's the most useful information I could ever give you. Buy low, sell high. If you can do that, you're going to be better than pretty much everybody else. These stock chart patterns, in theory, are fractals. They appear across different time frames. Weekly, you'll see head and shoulders. Daily, you'll see head and shoulders. Monthly, 5-minute, 15-minute, 1-minute, 30-second, you'll see head and shoulders all the way down. They fractal down through all the different time frames. So go take a look at those. Go study them if you want. And you can use the on-demand feature with Thinkorswim to go back and trade real time. You can find a stock chart pattern, maybe enter a buy order with a stop loss or whatever, and then you can fast forward in time and see how you did. The last thing I want to say is you also have to just get the feel of the stock. Do you feel like it's bottoming out? Okay, so for example, let's go to CVS really quick. I was talking about CVS before it broke out to everybody in one of my previous videos. I was looking at the weekly chart. What was happening on the weekly chart? Okay, I could not see this area right here. I did not know about that pop out yet. We were looking at it probably around in here. What are you seeing? Well, you see this really long downward trend. We see those lower highs and lower lows that we discussed. The downward trend is very obvious. It's staying below all of these moving averages and keeps getting rejected by those moving averages, which means they're acting as resistance, which means it's in a downtrend. But then what happens? It bounces off twice around $51, which means there's an area of demand, and those lower highs start not being so low. And then the next thing you see, and you can already see I have my line there from my previous video, is that the lows become higher and the highs stay constant. That means that the highs are not going down. The lows are becoming higher, the highs are not going down. We're starting to see a shift in trend. So you just look at this with your eyeballs. You see it slowing down. You see people kind of like hesitating, like maybe we don't want to keep selling. We're not so sure the intrinsic value is any lower than the current stock price. We're going to calm down a little bit, and that reflects as less lower highs and less lower lows. And then you start seeing higher lows and then maybe potentially higher highs. Now we definitely see a higher high. So I bought some CVS right in there. I was going to buy a Leaps, kind of wish I did now, because you can see it is just starting to turn around. You do not have to get super brainy with it. The only time you have to get super duper brainy with it is if you're day trading, but you should probably just go panhandle. I bet the guy underneath the freeway over there makes more money than most day traders. It's easier when you're looking at long-term trends. Not everything's so high frequency and quick, and you can have smaller position sizes because the swings are much larger when you're looking at a daily or weekly time frame as compared to a 5-minute or 1-minute time frame. And so I bought, and you know what? I'm making money. I could smell this pop off coming. I could smell it. You could see it slowing down. You could see it turning around. The trend was shifting. It started busting above those moving averages. It was holding above those moving averages. You can see the buy signal on the MACD, and the RSI is not yet overbought, although it's just kissing that right now. So without even looking at the company that much, although I did skim some articles and stuff, without even looking at the fundamentals of the company, you can analyze what people are thinking about in regards to the fundamentals just by looking at the stock chart. And you can see people are starting to change their mind. They're starting to think the company might be heading in a more positive direction. And then bam, you have this massive breakout to the upside, which is basically just proving me right. I haven't added much more to my position. Maybe I should, but it could easily correct back down a little bit. I'll be much more inclined to add my position if there's a little bit of a correction, particularly because it is a little bit overextended, just eyeballing it. And on the RSI, it's a little bit overbought. Okay, so when you're looking at long-term trends, that's the kind of mentality I want you to have. When you're looking at price corrections or price improvements, you're going to be looking at 15-minute time frames and analyzing it similar to how we're doing it here, but instead of buying or selling, you're just going to choose where you want to put your limit order for your stock or for your options. people who have support and resistance lines like this and over here, you know, you got stuff going through here and there's tons of lines and stuff. You're not going to be able to identify which line is more valid than the other, and it's just a bunch of gobbledygook anyway. So just look and feel out how the trend is changing or moving or what it's doing. Okay, it's a little bit intuitive as well. Also, that's a hell of a dip. Like I said, buy low, sell high. Okay, that's it for today. That's basically just a little introduction into technical analysis. Go get some free stocks down below. It's just literally just free money. If you haven't checked out Webull or Robinhood or whatever down there, M1 Finance, Adam. Also follow me on Iris. That place is super, super sick. Really, come follow me. That's where I post most of my memes anyway. Love you guys. I'll catch you later.